Okay, so in Chapter 8 we talk about receivables, and accounts receivable arise when we provide a good or service to someone but they don't pay us right away, so they're going to pay us in the future. And the problem that comes with that is that sometimes people won't always pay you. And there's two different ways that we can account for this. The first is the direct write-off method, which is not allowed under GAAP, and then we have the allowance method, which is allowed under GAAP. And we'll see in exercise 8-13 how these two different methods work. Okay, so we have some transactions for the year for Shipway Company, and the first question says to journalize the transactions under the direct write-off method. So part B, we'll do the allowance method, but first we're going to do the direct write-off method. So if we start with our first date, April 13th, it says that the company wrote off the account of Dean Shepard, which was for $8,450. So under the direct write-off method, we write off things when we know they're uncollectible and not until that point. So account receivable is an asset. So if I'm writing off an asset, I will need to credit it because I reduce assets by crediting. I increase them by debiting. So I'll write off the account receivable for Dean. And then the offset is going to be an expense, and we call it bad debt expense. So that is writing off an account. Okay, so then on May 15th, it says we received $500 as partial payment of the $7,100 account of Dan Pyle, and we wrote off the remaining balance as uncollectible. So we did receive partial payment from this other account, but the remainder of it, for some reason or another, we know is going to be uncollectible. So the first thing we know is that we received some cash. So cash is an asset. We increase assets by debiting. So we'll increase our cash by 500, and then we'll do the same thing. We're going to write off the account receivable, the full amount, because we're getting it off our books. Part of it we collected in cash, and then the remainder will be the bad debt expense. So if we had collected all of it, it would have been cash for $7,100, account receivable for $7,100. But since we're only collecting part of it, we'll put the other part to a bad debt expense. Okay, the next one, July 27th. We received $84.50 from Dean Shepard, whose account had been written off on April 13th. So we need to reinstate the account and record the cash receipt. So the first thing we need to do is reinstate the account. So that means we need to put the receivable back on the books. So on 413 up here, we see we wrote it off by crediting it, so that decreased the balance. So we're going to increase the balance by debiting it. So we'll put on the $8,450. And then we need to undo the bad debt expense also. So undo that. So this is to reinstate an account receivable. And then I said we also received the money. So we're going to get all of the cash. And when we get the cash, they no longer owe us, so we can write off the account receivable. Okay, and then 1231, it says if we wrote off the following accounts as uncollectible and we want to record them as one journal entry. So for that one, let's put in another page here so I can actually write this out. Okay, so I've got that fixed. For 12, 31, we want to write off the following accounts as uncollectible. So we're going to do this the same way, just this time we have a bunch of them. So we're still going to write off all our accounts receivable. We have to do each of them as its own line item because our accounts are kept separate. So we've got account receivable from Paul Chapman for $2,225, from Dwayne for $3,550, from Teresa for $4,770, from Ernie for $1,275, and then from Marty for $1,690. So I'm getting rid of my account receivable since they're normally a debit balance. Since they're an asset, we'll undo them by crediting them. And then the offset is going to be my debit to bad debt expense for the sum of all of those, which is $13,510. And then the second thing on December 31st right here says, if necessary, record the year-end adjusting entry for uncollectible accounts. We don't need to do that because we're doing the direct write-off method. So this is the second one. And we have no entry for adjusting uncollectible accounts because we're using the direct write-off method. Okay, so that's the direct write-off method. If we go down to part B, we're going to journalize the transactions under the allowance method. So it tells the Shipway Company uses the percent of credit sales method of estimating uncollectible accounts expense based on past history and industry averages. 0.75% of credit sales are expected to be uncollectible, and it has recorded $3,778,000 of credit sales during the year. So the first thing we have is what happened on April 13th, which was we wrote off an account of Dean Shepard. So we're going to write off the account, so we're still going to credit the account receivable, but instead of recording it to the expense, we're going to record it to the allowance for doubtful accounts. Because under the allowance method, we make a reserve for accounts that we think will be uncollectible throughout the year, and we record the expense at that point. Okay, so then on May 15th, we receive $500 as partial payment, and then we write off the remaining balance. So once again, we receive the cash of $500. We undo the account receivable for, who is it? Dan. And then the offset is going to go to allowance for doubtful accounts instead of the bad debt expense like it did under the direct write-off method, because we record bad debt expense under the allowance method when we record the reserve. Okay, so then on July 27th, we received some balance from Dean Shepard, whose account had been written off. So once again, we need to reinstate the account. So we're going to undo what we did on April 13th. So we're going to put the account receivable back on the books, and we're going to put it back into the allowance for doubtful accounts. So this is what we're undoing right there. Okay, and then we receive the cash. So we're going to record the receipt of the cash. And once we get the cash, they no longer owe us the receivable. Okay, so then we have what happened on 12/31. If we need to write off all of our accounts receivable, just like we did for the direct write-off method, but instead of debiting bad debt expense, once again, we're going to do allowance for doubtful accounts. So it's going to be the same, 13,150. And then we'll have account receivable for each of them. Paul, Dwayne, Teresa, Ernie, and Marty. All of the same numbers that we had previously. Okay, and then we have another 12/31 where we need to record the year-end adjusting entry for uncollectible accounts. So this is where we actually record our bad debt expense. So we would have a debit to bad debt expense, and we have a credit to the allowance for doubtful accounts. And we need to figure out what number that is. And we figure that out by looking at the supplied information. So they tell me we recorded 3.778 million of credit sales, and we expect 0.75% of those to be uncollectible. So in order to get this number, we're going to do our credit sales of 3,778,000, and our estimate is that 0.75%, so 0.0075, because 0.75%, and that's 0.75 divided by 100. And if we do that, we get 28,335. Okay, and then moving on to Part C. How much higher or lower should Shipways Company net income have been under the direct write-off method than under the allowance method? Okay, so we're talking about net income, so we're talking about revenues and expenses. So the only expense that we've talked about so far is our bad debt expense. So if we look to those two T-charts, so if we look under the direct method and we look at our bad debt expense, on 4/13 we recorded 8,450. On 5/15 we recorded 6,600. On 7/27 we undid the 8,450 that we recorded on 4/13 because it became collectible again. And then on 12/31 we recorded all of our uncollectible accounts of 13,510. So we do that, we get a total of 20,110. And then if we look at our allowance method, if we look at our bad debt expense T-chart, we'll see that we only recorded on 12/31 a balance of 28,335. So the difference between those two is 8,225. So we can see that the expense is lower under direct in this case. So in that case, our net operating income will be higher under the direct method.